All right, welcome. Today, we are going to tackle one of the most important tools for really understanding any business, the income statement. Think of it like this. We're going to peel back all the layers and see the real financial story of a company, starting from those big, flashy sales numbers all the way down to what's actually left over.
So let me ask you something. A software company, let's call them Pixel Perfect, they just announced they hit $10 million in sales this year. Pretty impressive, right? That sounds amazing, but does that mean they're actually rich?
Well, not so fast, because that huge $10 million number, that's just the beginning of the story. It's what we call the top line. To figure out if Pixel Perfect is actually making any money, we've got to follow the cash, right? We have to see what's left after every single bill gets paid. And that journey, well, that's exactly what the income statement shows us.
So what exactly is this thing? Well, the income statement, you'll also hear it called the P&L for profit and loss. It's basically a financial report card for a business. It just lays out all the money that came in, which is revenue, and all the money that went out, its expenses, over a set amount of time, say a quarter or a whole year. Really, its entire job is to answer one simple but super important question. Did we make money or did we lose it? Okay, so our story starts right at the top. And the first big question we need to answer is this. Can the company actually make money just by selling its main product? To figure that out, we're going to calculate something called gross profit. Now, before we get to any kind of profit, we have to subtract our first big chunk of expenses. It's called the cost of goods sold, or COGS for short. Just think of these as the direct cost of making the thing you sell. So if you're a car company, it's the steel, the tires, the wages for the people on the assembly line. For our software company, Pixel Perfect, it's stuff like server costs to keep the software online or the salaries for the developers who are directly working on that specific product.
And the math here, it's actually super simple. You just take your total revenue, that big number from the start, and you subtract the cost of goods sold, and boom, what's left over is our very first level of profit, the gross profit.
Okay, let's plug in the numbers for Pixel Perfect. They started with that $10 million in revenue, right? And we're saying their direct costs, their COGS, came out to $3 million. So that leaves them with a gross profit of $7 million. Hey, not bad. Looking pretty good so far. Yeah, this $7 million gross profit, it tells us something really important. It tells us that Pixel Perfect's main product, their software, is fundamentally profitable. They're selling it for way more than it costs them to actually make and deliver it. This is like the first crucial health check for any business.
But of course, just making the product isn't the only cost, is it? You have to actually run the entire business. And that brings us down to our next level of profit, operating income.
So this is where operating expenses, or OPEX, come in. These are all the other costs you have just to keep the lights on, the things that aren't directly tied to making one more widget or selling one more software license. We're talking about salaries for your marketing and sales teams, the rent for your headquarters, your advertising budget, and of course, all that money you pour into R&D to create the next big thing. Okay, so the next step in our little financial waterfall here is to take that gross profit we just calculated, and now we subtract all of those operating expenses. The number you get is called operating income. You'll also hear it called EBIT, which just stands for earnings before interest and taxes. So let's update the books for Pixel Perfect. We left off with $7 million in gross profit, but now we're saying they spent $4 million on OPEX, all that marketing, rent, and salaries for everyone not directly building the product. After we subtract that, their operating income drops all the way down to $3 million. And here's why this number is so important. Operating income is an incredibly powerful metric. It tells you exactly how profitable the company's core business is. Without all the noise from debt or taxes, it strips all that away. This is exactly why investors and potential buyers obsess over this number. They're trying to answer one question: how well does the actual business engine run? And operating income? That's the answer. All right, we're almost there. The last part of our journey takes us from the profit of the core business all the way down to the famous bottom line, the final actual net income. So how do we get there? We start with our operating income, and then we make just a few final adjustments. We have to subtract any interest we paid on loans. We account for any weird one-time things, and then Uncle Sam gets his cut. We subtract the income taxes. Whatever is left after all of that, that is the net income. And here it is, the final chapter for Pixel Perfect. They had that $3 million in operating income, but they also had to pay $500,000 in interest on some debt, and then they paid another $625,000 in taxes. So remember that impressive $10 million in sales we started with? It's now trickled all the way down to a net income of just under $1.9 million. That is the bottom line.
But here's the secret, the thing most people miss. That final number, it isn't actually the most interesting part of the story. The real aha moment, the real insight, comes from understanding the relationships between all these numbers. And that, my friends, is where margins come in.
You can really see that waterfall effect we've been talking about, can't you? We start with this huge block of gross profit, then it shrinks down to operating profit once we pay for running the business, and finally, it gets even smaller, down to the net profit after interest and taxes. Every single one of those drops tells you something critical.
And this is where things get really, really powerful. When you look at these numbers as percentages of revenue, what we call margins, you can basically diagnose the health of the business. For instance, if a company has a fantastic gross margin but a terrible operating margin, what does that tell you? It tells you the product itself is profitable, but the cost of running the business, the overhead, is way too high. On the flip side, what if the operating margin is great, but the net margin is tiny? Well, that means the core business is run efficiently, but huge debt payments or a high tax bill are just eating up all the profit. It's like a financial X-ray. It shows you exactly where the problem is.
And because of this incredible diagnostic power, a lot of analysts will tell you that the operating margin is the single most important number on here. Why? Because it isolates the health of the core business engine. It cuts out all the noise from financing choices and tax strategies. It just tells you, plain and simple, is this fundamental business model working or not?
Okay, so let's wrap this up with the key takeaways. First, the income statement isn't just a bunch of numbers. It tells a story from the top line all the way to the bottom. Second, each level of profit, gross, operating, and net is like a different chapter in that story, revealing something new about the business. And finally, remember that the margins are your ultimate diagnostic tool. They're how you really find a company's strengths and its weaknesses.
So in the end, the income statement really shows us that while net income might be the final destination, it's the journey to get there that tells the real story. It's the journey that reveals if the product is a hit, if the company is run well, and how smart its financial decisions are. So I'll leave you with this to think about. When you look at a company, what part of that journey, from revenue to net income, do you think is the most important piece of the puzzle?